In this video, we're going to talk about my 3 favorite option strategies, plus a bonus, options that never expire. So if you want to make money trading options, don't do what everyone else does. And if you've talked to people, if you've traded a little bit on your own and tried options, a lot of the time, because of the volatility, because things can change so fast, it's actually pretty easy to lose money. So I did this AI search, and you could do the same thing if you want. And I asked how many people lose money trading options. And the answer came back, estimates of the percentage of options traders who lose money range from 90% to 93%. And the reason cited was lack of knowledge. So many traders don't understand how options trading works, the risks involved, or how to manage risks. So, I take my hat off to you right now for trying to learn a little bit more. But when I started off trading options, I bought calls on stocks that I thought were going to go up, and I bought puts on stocks that I thought were going to go down. And a terrible thing happened to me when I first started trading options, and I won on my first 3 trades. And I go, this is fantastic. For a tiny amount of money, I can make a big profit. And I thought my biggest problem in life was going to be what color my Mercedes-Benz was going to be. And then I just went on this losing streak to the point where I lost my entire account. And I think most options traders have lost their account. I mean, even if it's a small account, maybe 2 or 3 times before they start getting some things figured out. So, I think of options as this fantastic power tool. If you want to cut a board in half, it's a lot quicker and easier to use a power saw to do it. But you can also, cut a finger off. So, when you're using a handsaw and the equation there is, just buying a stock and waiting around, that's like using a handsaw. Well, nobody ever, that's slow, admittedly, but nobody ever cut their finger off using a handsaw, or hopefully they haven't. So, that's the analogy. These power tools are incredible. They can do wonders for us. They can do a lot. But you want to really do something, and this is so important if you take nothing else away from this video, you want to do something that stacks the deck in your favor mathematically so that the probabilities are on your side. And that is so darn important. When I first started trading options, I thought, well, my big edge was going to be how smart I am or how quick I am. And I learned very quickly that trading can be a humbling experience. And I had to go back to the drawing board and find out what really works. And so that's what I'm going to show you today. I'm going to show you some things that actually really work from a lot of real world trading. So our first strategy, and just the absolute bread and butter, has been for many years has been selling credit spreads. So there's a little commentary on this chart. This is actually from my credit spread trading service that comes out late every Tuesday night, so we can make trades Wednesday morning. And this is talking about this particular stock is Federal Express. It says FDX is clearly in a downtrend, and after a little rebound, that trend should continue. We'll be selling above 2 strong levels of resistance for a higher probability outcome. So you find something that's trending, and it doesn't matter if it's going up or going down. So if it's going down, what we're going to do, and the way we're going to trade this now, in the old days, I would have just bought a put. Well, here's what happens when you buy a put. You not only have to be right on direction, but you have to be right on timing, because that option is decaying in value every single day because of something called time decay. Options have an expiration. When they hit that expiration date, they've got 0 time value, and it's very, very easy to lose. So I want to, after many years, I hate to admit it, but after many years of trading, I figured out that with options trading, what you really want to do is put time decay on your side. And you do that by becoming a seller of options instead of a buyer. So we're going to sell this call option right here. And when we do that, we take in money. We take in a credit. It has value. Now, the interesting thing about options is you can open a position by selling. Most people think you have to buy something to open a position, but you can open it by selling. Now, we could just leave it right there. But if this stock turns around and goes to the moon, really shoots higher, we don't want that unlimited risk. So in order to hedge ourselves, in order to do something a little safer, we buy a call option just above it. Now, in this case, we're buying the 270 calls, or excuse me, we're selling. It's important to get this right. We're selling this close when we're selling the 270 calls. We're buying the actually right here, we're buying the 272.50 calls. So that's a $2.50 spread. And what we're really shooting for is about 40 to 50 cents on this spread. So let's just do our net credit is 50 cents. And to understand where that comes from, the option that we're selling is closer to the underlying, so it has more value than the option that we're buying. Our net on this is 50 cents on a 250 spread. So let's just real quickly figure out our rate of return. So our spread, and that's the spread is the difference between these two strikes, is $2.50. And so that is theoretically our max loss, but we take in this 50-cent premium. So the max that we can lose on this trade, if just everything went haywire, is $2. So if we have a possibility of making 50 cents on a $2 risk, that's a 25% return. And that's typically what we shoot for, around a 20 to a 25% return. There's been times when we put on this trade and then it shoots back up and we actually get more than 25%. So can you see what's going on here technically? So we have a big downtrend. We have all these lower highs. And then this really important horizontal support here got broken. And then it got rejected here again. So that proves it's that old support is turned into new resistance. And then it starts bouncing up higher. And then we collect our credit. The thing rolls over, which is very likely to do. And that's where we make our money. Now, I want to go over a really quick concept here on why this gives you such an advantage versus straight buying of options, buying of calls and puts, is to sell these spreads. By the way, this is called a bear call spread. It's bear because we think the stock is going to go down, and it's a call spread because we're buying and selling calls. There's also something called a bull put spread. That's on a stock that's going up, so that's the bull part, and you're selling and buying puts, and that's how you do it. So you could do it on stocks going up or going down. Frankly, you could even do it on stocks going sideways, but you might as well stack the deck in your favor as much as you can. So this is what I tell people real quickly about this strategy. There's only 5 things that a stock can do once you get into the trade. It can go up dramatically. It can just kind of go up. It can go sideways. It can drift lower, and then it can drop like a rock. Okay, those are the 5 scenarios. And on this one, once you put on this bear call spread, if the thing drops like a rock, you make money. If it goes down a little bit, if it drifts lower, you make money. If it goes sideways, you make money. If it even goes up and it kind of goes against you, but it doesn't go up very high and very fast, you still make money. The only way you can lose on this strategy if this thing just goes through the roof and goes through your spreads. Now, real quickly, if we put a stop right at this sold strike, it actually cuts your potential loss in half. So instead of a potential $2.50 loss, you're looking at $1.25 cost to close minus your 50 cents from that $1.25, and you don't have nearly as much risk as you might initially. So this is a strategy. It works really well. We sell typically about 9-10 days a time, depending on the volatility. You might have to go out a little bit longer than that, but this has been a real bread and butter cash flow strategy for us, and it's worked really well. So I'm going to move along really quickly and talk about the advantages and disadvantages of selling credit spreads. So advantage is your probability of winning is 80% or more. That's not my opinion. That's from the Black-Scholes pricing model. Depending on the delta that you're selling, you can actually increase that. So pretty darn safe. Now compare that to the guy that's buying a call or a put that has a 20% chance of winning. So if you've lost money buying calls or puts, that could be a really good reason why. Like I say, it took me a long time to figure this out. I'm glad you're getting this information a lot quicker. So you get your potential profit up front. This is more important than you might think. So the minute you put on that trade, you get a credit in your account. So I've had some crazy things happen to me before. So right after the Ukraine war, when the Ukraine war broke out, I traded a credit spread. I sold a credit spread on a Russian ETF. And I thought, well, it's probably going to go down. Russian assets aren't doing very well. I think I'll make a bet on this. So I sold my spread. I got money into my account. It immediately came in. And then the very next day, the US government comes out and says, okay, we can't trade any more in any Russian assets. We don't like Russia. We're not going to do anything with those guys. We're sanctioning the country. And we're going to halt trading on this Russian ETF. They just stopped the trading. Well, for me, that was great. I mean, I already got my money. But the poor guy that sold me my options, he's just out. And this has happened to me. This happened to me on GameStop. I sold a spread on it, and the spread even kind of went against me. And they stepped in. The government I don't know if you remember GameStop, the meme stock, when that was all going crazy. And they just stopped all options trading on GameStop. And I go, well, I collected my profit already. That isn't something that's regularly going to happen. It's an absolute fluke. But I'm just trying to outline the advantage of getting paid first. And when you get that premium, you get to keep it. I mean, no matter what. And, the trade could go against you and you could potentially lose, but you get to keep that premium. And I really like that. Now, this next one is a huge one for any options trader, and that is time decay is on your side. Time decay has probably lost more people money with options than any other single factor. And that just, a big joke in options trading is the exact same thing happened with the stock that you thought was going to happen. Like you thought it was going to go up, and it did go up, and it goes up the day after your option expires. It's kind of a bitter kind of a joke, but boy, that happens. So when you put time decay on your side, you're really stacking the deck in your favor. So much so that your timing can be off a little bit and you can still win. Like you don't have to be perfect. When you're buying calls and puts, when you're buying them, you really actually do have to be perfect on your timing. This, you can screw up a little bit and still win. It's a very forgiving strategy. And next, your direction can be off and you can still win. So like I showed you, this trade can actually go against you a little bit. Like you're not so clever on your technical analysis as you thought, and you get a little surprise and you can still win. And that last thing that I mentioned is you can set stops to cut your potential losses in half. So this right here is a lot of advantages. It really stacks the deck in your favor, and that's why I like it. What's the disadvantage? What's the complaint that people say when you bring up credit spreads? And that is something that you can lose more than you can win. So like I said, even if you cut your risk in half by putting a stop at your sold strike, if you can lose $1.25, and even if you took in that 50 cents, that's still a potential 75 cents you can lose. And that is obviously a bigger number than 50 cents. And then on a $5 spread, you just double that. On a $5 spread, like on the SPX, you take in $1, you can potentially lose $1.50. So that's more. But mathematically, this comes out because if you're winning 80% of the time, you can do the math for yourself. You'll see that this disadvantage where you could potentially lose more than you can win, you can actually mitigate that and come out a winner most of the time. So that's credit spreads. I really like them. They're really cool. And let me take you to my second strategy next, my second favorite. So this is a strategy that I absolutely love. It's called selling calendar spreads. I personally call it the greatest option strategy on earth. I know that sounds really grand, but I started doing this back in the late 90s. And for those of you that have been around a long time, or if you just take a look at historic charts, in the late 90s, the stock market was just going up and up and up. And that was the big, what they called the dot-com bubble that finally burst in March of 2000. So those last 3-4 years of the 90s was just an incredible time to trade. There was a lot of trending. And a guy turned me on to selling these calendar spreads, and it made me so much money. From then on, I called it the greatest option strategy on earth. And here's why. With options, of course, we're trying to make a big win. We're trying to make a lot of money. But with as you saw with our credit spread strategy, it's also really nice to have cash flow. I mean, that's what gets you to the grocery store, and that's what pays your rent, and that cash flow is pretty cool. So what I love about this strategy is it gives you sort of like the best of both worlds. So here's what you do. And you can do this on a downtrending stock, but most of the time the market's going up. And when you have a situation where the big indices are going up, over several months and things are really bullish, this is like the best strategy in the world. But like I say, in a bear market, if it looks like it's going to be a bear market for quite a while, this strategy works there too. So here's how you do it. It's pretty straightforward. So you buy a multi-month call option. So in this case, we're buying a call option with six months of time. So we have 6 months of time on this thing. It's a lot of time. And right here, we saw, and this might be a clue on when to do this, we saw a little breakout on this stock. So it broke above, this is an expensive stock. This is Meta. this is is doing pretty good. But you can see here that it mostly traded sideways for several months. So you don't have to have a radical uptrend. You just have to have an uptrend. So it broke resistance at about $525. And so we bought the 510 calls. And I have a formula for this. We do about a 70%, 70 delta. So you buy them in the money a little bit. And what we're trying to do by buying in the money is getting sort of like a surrogate stock. We want this thing to act like the stock, but we don't want to spend $525. And so on this particular option, we spent $20, which might seem like a lot of money for one contract, but it's a heck of a lot cheaper than $525. So the idea here is to just radically increase your rate of return. And if you're selling covered calls on a $525 stock, you're kind of picking up nickels and dimes compared to what that stock costs. But if you're spending $20 on a long-term option, that is so darn cheap. So what we do is we set a stop in here. You can set your initial stop perhaps at your strike price, but somewhere where you really don't want to lose too much money at this. Fortunately, with this breakout, the stock went up, and I'm gonna show you a little trick here that works really well. So right underneath here is the MACD. So that's the moving average convergence divergence. A lot of you have heard of it. It's one of the most common technical analysis tools that there is. Down below here, if you're wondering what this blue line is, this is on balance volume. So is most of the volume on the buy side or the sell side? It just gives you a really good idea whether this thing is going up or down. So with the moving average convergence divergence, you'll see that I make a little hash mark here, and that is where these lines cross over. So in this instance, you don't use the histogram when it starts going down. You use it when these moving averages actually cross. You use that as your sell signal. And so we sold a few days of time here. You can sell a week at a time, whatever you want, a few days at a time. But we took in kind of a sweet $3. So our initial investment was $20. We took in $3. Now our investment is $17. So you actually have less risk. So the stock basically goes sideways here, but we have another moving average convergence divergence right here. And I said, oh, okay, this is a good time to sell. And then at that sell, we sold a few days at a time, a week at a time, whatever, and we took in $4. So we had $17 here as our cost basis. We now take in $4. So that gives us $13. And then, our risk is even lower. And actually, if you figure the amount of income that you're getting percentage-wise on a $20 investment, or in this case now, a $17 investment, just your rate of return, like a dividend, is just absolutely gigantic. If you just figured it out that way alone. So sure enough, this MACD told us what was going to go on, and the stock kind of bottomed here. Our call option that we sold expired, worthless. Now, you don't have to do a spread on this. You sell a call because it's always hedged. This call right here is hedged against our longer term call down here. So here's our theory, is if this got called out, if the stock went above this and they called the stock away from us, we can satisfy it with this call that we have way down here. And look at how much you would make the difference between these two. So, we got a lot of time left. This one expired, worthless. And so the stock starts to go back up again, and nice little trend, except boom, what do we see here? We see a crossover, and that means it's time to sell again. And this time we took in $3. So our $17, this was 17, this is 13, $3. Our cost basis is now $10. And if we get called out now, there's an even bigger difference between here. Heck, we're like at, 45 or so in our strike price, and our option is all the way down here at 510. So if we get called out, they hand us a huge sack of money for our trouble. And then it goes down, this expires, worthless, it pops back up again, and sure enough, we have another crossover right here. We sell our option, we get $2 this time. It drops down, this expires, worthless. The stock really takes off. Didn't need to do that, but we didn't sell anything as long as it's just sky and higher. But as soon as that thing looks like it's going to turn around, as soon as it crosses over, sure enough, we go out of the money a little bit and we sell another call option. And then we kind of run out of time. Our 6 months is up. So the gig is up here. And we could also, instead of selling this call option, if it's this close to expiration, we could have just closed the position at a huge profit. But look what happened here. So our initial investment was $20. We took in $16 in credits, in income. So now we have a $4 cost basis. This is all this 510 strike cost us. And the difference between our strike at 510 and where the stock's going, like $673 right up here, is about $163. So that $163 is your pot of gold at the end of the rainbow. And that's if you just, got out of the thing. But, you can actually close this trade anytime you want. Like if it's up here and it's peaking and you see that it's rolling over, you can actually not sell anything. You can just not sell a new call option, but you can decide, okay, well, this looks like it's rolling over. I'm just going to sell my 510 calls for, my gosh, this thing is, $740 or something. You just make a fortune. Now, Meta, yes, an extreme example. I mean, the stock went up quite a bit. This last little run here was just huge, but this works on any uptrending stock. Obviously, a cheaper stock is going to provide cheaper long call options. It's also going to get you less money when you sell the call. So it's all relative. When I first introduced this strategy back in the late 90s, I used a monopoly board because when you're buying Boardwalk and Park Place, it's just like you're buying Meta. Your initial entry price is greater, but when you sell the calls against it, that's a lot bigger too. If you don't have enough money to buy Boardwalk or Park Place, you can buy a stock that's $30 or $40 and it looks like it's on a good solid uptrend. That way your entry price will be really low. And you'll be able to afford that. The point is, with this strategy, you have the best of both worlds. You have the potential of making a huge amount of money at the end of the thing, and you have all this great income along the way that provides money coming into your account, plus it lowers your cost basis and lowers your risk. So let's just talk about risk one more time here. So it's really important that you put a stop in here when you initially buy this long option, because we can all be wrong. So maybe this is a false breakout and the stock just turned around and went right back down. So you want to stop in here to limit your losses. But there's another place to put stops. As this stock starts rising, you can say, oh, okay, so this seems to be support, and maybe I'll put a stop down here. And if you would have done that, maybe you would have gotten stopped out here, and that's still okay because you still would have made money on this trade. The point is as the stock goes up, you start raising your stops, and maybe you keep raising them, and so that when this thing goes down, you actually sell out of your position. But the point is, and this is really, really important, the most risk you'll ever have in this trade is right here at the very beginning of it, if this thing were to reverse and hit your stop. Because once it goes all the way up here and you sell a call, and if you were to raise your stop up here somewhere, even if you get stopped out with this reducing your cost basis and getting stopped out at a higher price, you're not going to lose money. So this is honest to goodness. I mean, if you want to do something that could potentially get you retired, I think this greatest option strategy on earth is like one of the best. The reason I don't do them as much in my subscriber service anymore is because if you get multiples of these going on, you have to follow them all the way through for the 6 months. So if you have 5, 6, 7 going on, it becomes overwhelming to track them. But for the service, I might have one going on periodically when I see a really nice trend. But in trending markets and in a trending stock, I mean, I almost can't even think of a better way to make money. This is just amazing. So that's why I call it the greatest option strategy on earth. So let's real quickly take advantage, or take a look at the advantages and disadvantages. So your advantage number one is your delta is high enough that the option acts like the stock at a massively reduced price, which means far better return on investment than covered calls. So we're going to put a check mark on that. This is a really good use of your money. It makes your money go a long ways. So you create income that reduces your cost basis and your risk. Super important. You're reducing your risk as you're going, and you're getting some of your money back. So it's kind of like a dividend stock that way, except, I mean, the dividends you're getting are massive, and you get to decide when to take them. So when you get called out, you still have a profit. I love that. So you sold a little too close to the underline and it kept on going. Your MACD didn't exactly play out like you hoped, but you still make a profit. Not bad. You have the potential for a gigantic win, and that's that pot of gold we saw at the end of the rainbow with Meta. So the risk is low. Set a stop that rises with the stock, and we just took a look at that, and you can really mitigate your risk. So let's take a look at the disadvantages. If the stock reverses right after buying your long call, you could lose. But you know what? Here's what's cool. That's about the only time you can lose. If the stock goes up enough for you to be able to sell against it, and then you set a stop and a rising stop, and you've already taken in money, which reduced your cost basis, you just pretty much eliminated your risk. And hopefully you have another, 5 months or so to sell against this thing. So the disadvantage is minimal. The advantage is super high. And that's why I love this strategy. And if you get acquainted with it, I think you'll like it too. Okay, let's move on to strategy number 3. This has gotten popular lately, but there's a right way and a wrong way to do it. So this is selling 0 days to expiration spreads. So they call those 0 DTE spreads. So most people will buy like a strangle or a straddle, where they'll buy a call and a put on the same stock on the last day of expiration, and they try and make money that way. Once again, time decay is never a bigger factor than on the last day of expiration. I mean, you can actually watch the time value of an option decline hour to hour on the last day when it's getting ready to expire. So what we do is we take all those benefits of our credit spread strategy and we apply those to the last trading day of expiration. Now, what I like to trade on 0 DTE options is the SPX, and here's why. We have a expiration on Monday. We have an expiration on Wednesday. We have an expiration on Friday. And if you had a really great way to make money, would you rather be able to only do that on Fridays, or would you would like to be able to do that, 3 days a week? So here's some examples, and we have some formulas for this. We only sell like a 15 or a 20 delta, so we have like an 80 to 85% chance of winning. We do a condor, so we do both sides, and that allows us to sell further away from the underline and still collect our minimum amount of money. So on a $5 spread on the SPX, we're looking for $1 in total. So we might take in 40 cents on one side, 60 cents on the other, or 50 cents and 50 cents, whatever it is. But we're looking for around $1. And the volatility will determine that, and the implied volatility determines what those options are worth. So as you can see, we did this one here. It bounced around a little bit. Sometimes it gets pegged at a strike on the last day, and it just goes sideways. So this one we made money. This one we made money. This one we made money. This one, it went up a little bit, but our spread was what? It was never even threatened. Okay, and then you come to a day like today. So it opens up. Or not like today, but this day right here. And it opens up down massively, goes sideways a little bit, and then just falls through the floor. So our call spread is going to be fine. We make money on that. That's no problem. But on the put side, look at what happened. Before the end of the day, it just plunged through the put side, and we made, and we took a loss on that. So once again, now if you don't have stops on here, and we actually don't use stops on the last day because we've experimented. Sometimes we use stops, but essentially the bid-ask spreads get really wide and it's very expensive. On something like the SPX where it's just cat settled, it's kind of efficient. They just either, the money is in they leave it in your account or they take it out of your account. So in this one, there's a loss, and this would have ended up being on a $5 spread. It would have been, if we took in $1 on this whole thing and this loss went through, that would be a $4 loss in total. So you can see if we're making $1 on each trade, would take 4 trades to overcome that. But here's the thing. We're working and we're learning about this, and we're learning that if there's huge volatility right at the beginning of the day, it's going to be an absolute crazy day. What we're learning is we just don't trade that day. Now, listen, we've got 3 expirations every single week. We've got Monday, Wednesday, and Friday. We can afford to miss a day, especially if it's looking insane like here. If this is the way it opens, and so we also don't open right at the very beginning. We wait an hour, hour and a half, 2.5 hours before we initiate our trade, because we want to see what the volatility is like. So if we have this kind of volatility, or if you see this kind of volatility right off the bat, you step aside. That's a crazy day. This over here, not a crazy day. This over here, not even this. This popping up higher, not a crazy day. This is obviously not a crazy day. That is too crazy to trade. So when you see volatility right off the get-go, it's not good. So you step aside. So we don't want to do crazy. Okay, so as you can see, the SPX adjusts downwards, comes up, and here's one where it popped up a little bit, kind of went sideways. So by the time we looked at this, it didn't look like a lot of volatility. This looked like a good time to trade. So we initiated the trade, and then the thing drops like a rock. And then once again, at one point during the day, it went down through our spread. But because we didn't have stops on it, we're not doing stops here, this thing recovers, and it actually turned into a profitable day because you can see that this thing closed above our put spread. And that often happens. So I've noticed that when things go up a lot, towards the end of the day, they'll sometimes reverse. Like, so traders are selling to take in their profits. And when they go down a lot, they do the same thing. That's what happened here. So on this last day here, it went down a lot. And then at the very end, people are covering their shorts or whatever they do to lock in their winnings. And the thing pops up, it reverses, and we actually made money on this. So this is something you have to be kind of precise on. I don't know if everybody's cup of tea because, it's a little bit of a nail biter. But we're looking to actually automate this style of trading because there's some advantages to it. So let's just take a look at those advantages and the disadvantages. So here's the advantages to selling 0 days to expiration spreads. Your time to decay advantage is massive. So your selling time, and that time is going away very quickly. We're not even doing the whole day. We're getting in like a couple hours into the trading day. We want to see that direction. We want to see if there's any big volatility before we get in there. Your probability of winning, just like our other trades, is over 80%. If you're selling a 15-20 delta, that's an 80 to 85% probability of winning. I like that. Your exposure to market news risk is less than 1 day. Something could come out in the middle of the day to change market direction. Like, for example, one of the things that we never do is use this strategy on a Wednesday where the FOMC is making an announcement. The Fed makes an announcement on interest rates. You don't want to be in the market that day because it can get volatile later in the day. So we just don't trade that day on any of those days, the Fed announcement days. So your returns are quick and potentially very profitable. 20 to 25% in a day is pretty awesome. Now, this is a big one. And with our regular credit spread strategy, this can be a risk. With this strategy, this is not a risk. There is no overnight gap risk. In other words, if a war breaks out on the other end of the world, or if something crazy happens overnight, you don't have your stock massively going one direction or another, potentially jumping past your stop. So that's a big risk when you're holding multiple days. That is not a risk if you're trading same day. Because it's the SPX, there is no assignment risk. That means nobody's going to force you to buy or sell this thing. It's all cash settled. The cash either comes out of your account or it gets put in your account. There is no cost to exit. We just let these go to expiration. A little controversial, but we're finding that works better. There are tax advantages to trading SPX options. So I'm not sure if you knew this, but check this out. SPX options are classified under IRS Section 1256 and qualify for the popular 60-40 tax rule, which allows 60% of gains to be taxed as long-term capital gains. And for most people, that's just 15%. And only 40% is short-term. And short-term capital gains are taxed at your regular tax rate. So for a lot of people that are trading, that's 22% or maybe even 28%. So this is kind of a nice tax advantage to trading SPX options. Very cool. What's our disadvantages? You can potentially lose more than you can win. So it's just like with our regular credit spread strategy. If we're bringing in $1 and we can potentially lose $4, obviously you can lose more on any one trade than you can potentially win, but the advantages outweigh that. And that's why we like 0 days to expiration trades. Okay, those are my 3 favorite options trading strategies. The reason they're my favorite, you can go over the advantages and see for yourself, but the reason they're my favorite is because they stack the deck in your favor. They put the odds on your side, and all things being equal, if you trade this way, you're going to win. All things being equal, if you're buying straight puts and calls, you are probably going to lose. Okay, so that's why I like them. Okay, now we're going to get into our bonus strategy, options that never expire. Now, this is something completely different. So the option strategies are fantastic. They're really fun. They're fairly quick, and I've never seen anything better for creating cash flow and money coming in. And with the greatest option strategy on earth, you can even get a pretty big windfall at the end of it. But I've never seen a trading strategy that could literally make you millions of dollars. And what we're going to take a look at here actually can. So the reason I call these options that never expire, what we're doing is we're buying these tiny little micro cap stocks. I mean, some of these things are smaller than micro cap. They're like nano cap. So I'm typically getting into recommending and buying shares in these companies that have less than a $50 million market cap. So some of them, I know this sounds crazy if you know about market caps, some of them are 10 and $12 million market caps, just like absolutely nothing. So the downside on these things can be enormous. It's just been kind of amazing what's happened. So this stock that you're looking at right now is called Quantum Computing, and their ticker symbol is QUBT. This is one that we recommended, oh gosh, back in, I think it was like 2018 is when I first got involved in the company. I actually got involved as a founder. There was some people starting the company. They knew about me. I'd worked with them before. Said, do you want to come in as a founder? There was 4 of us that originally put in money in the company. I put in money at 10 cents. I put in money before I recommend it to my people because I want to get to know management. I want to see what they really do. I want to see how they treat the shareholders, what their communication is, if they can keep the share count down, all of those things. So oftentimes I'm invested in something for a year or 2 years before I ever recommend it to our microcap or subscriber base or our accredited investor group. So this is one that we recommended. By the time I finally recommended it, shares were going for $1. As you can see, if you look down here at the bottom of the chart, so you look here at the price scale over here on the right. This is $2 here. This is $1. So what we're looking at is this price range in here is about $1 per share. So we got in as accredited investors, a direct private placement into the company. You're going to see why that's kind of an advantage in a moment. But eventually it got to the point where you could buy the shares of this company for $1, or in some cases even less. Now, here's the interesting thing, and this is why it's good that there's no expiration, is a lot of the time, we talk to management, this and that, they have all these big plans, they have all this stuff in the hopper, and they go, oh yeah, 2 years max, hold time, that's what it's going to be. And it turns out to be 4 years or 5 years, or in some cases 6 years. And, people go, well, I don't want to hold that long, that's a long time or whatever. When these things hit, I mean, this is a good example right here. It is like it is raining money. So I'm thinking, what are you doing for the next 4 or 5 years anyway? And if you've got the possibility to make some just absolutely mind-boggling gains. So this is the second time this thing took off. The first time was like back in 2020 or so, like in December. I mean, you can take a look at our chart, but it went up to like 28, 25, 28 bucks a share, somewhere in there. And then it just took off again more recently. So you can see the stock was just around $1 a share. It kind of popped up higher. It got my attention. I still had a bunch of shares left over in my account. I sold a bunch of them when the first time it popped up into the 20s, but I ended up with 15,000 shares left. It popped up right here, got my attention, came back down, and then it popped up again. And I said, I've got to get these shares transferred. They're private placement shares, so they're at the transfer agent. I'll teach you all about that. If you don't know about that, it's all really cool how it works. And then you get a hold of it, and there's this process, and you transfer them into your brokerage account. You get a selling window. Well, it took me a few days to do that. Finally got that window okayed, and this thing just took off. So what happened is, the government said something about, the Chinese are more advanced than us in quantum computing. We need to compete. We really need to get this thing on the ball, and there's about 4 really pure play quantum computing stocks out there. Regretti's one, IonQ's one, and quantum computing. And so all of these stocks just shot through the roof. So we have day one right here, and you see this big shoot, this huge amount of volume. The stock goes straight up. And then you see a gap from one day to the next, and you have the second day. And I've done this long enough. What I've noticed is it's a 3-day pattern, very typically before the stock is exhausted. So 1 day, 2 day, I'm waiting to pull the trigger. We get into this third day here, and I go, it is time. And this thing got all the way up here to about $27 a share, started backing off. You know, you'll never get top dollar, but I sold I sold 10,000 shares right here around the $23 level. So, you know, 10,000 shares at $23 is a very quick 230,000. And, you know, on this stock way back in the day, you know, I made about 7-8 million on it. And then here I just made a quick 200,000. And the reason I'm showing you this pattern and showing you what's going on here is it's literally like hitting the lottery. So it's just the amount of money you can make. And then when you see these huge spikes higher, you really do want to sell. And one of the mistakes people make is they go, oh gosh, you know, it's already up in the 20s. It's going to go to the 30s, the 40s. No, you get this 3-day run where it really goes parabolic. It goes straight up and you start unloading. You know, Charlie Munger was Warren Buffett's partner for many, many years. He's actually about, I think, 3 years senior to Warren Buffett. He was a great mentor to Warren Buffett. They ended up being partners. These guys are from the Midwest. They're kind of pithy. You know, they're kind of old school. And they had all these different sayings that they would say that I just absolutely loved. And one of them, Charlie Munger said, is when the ducks are quacking, feed them. When the ducks are quacking, feed them. So right in here, this 1, 2, 3 days, the ducks are quacking. People cannot get enough of these shares. They say, give me shares, give me shares, give me shares. When they're doing that, you be the one that's selling. You unload, you feed the ducks, you get rid of your shares. And here's what happens. Most of the time, they come down just about as fast as they went up. So you're going to be glad you sold some shares in the, and I have a whole series that I've done, a whole 10 chapter series on when to buy, when to sell, what to look for, you know, all of those good things. I want to give you an example of what can happen, and it does happen. The only thing is you might have to wait a while. So you don't do this with your grocery money. You know, you do it with money that you can set aside for a while. A lot of the time it takes longer than we think it's going to. That's kind of typical for these deals. But I mean, when it does happen, when they take off, it's just amazing. So let's just take a look at the advantages and disadvantages. So when I say the returns can be mind-boggling, we're talking about 10 times to 100 times on your money. And just to give you another example, the first one of these that we really did was American Battery Technologies that really took off. We got in the teens, you know, like 12, 15 cents. And then the stock dropped down to 3 cents. I was really in close touch with the CEO. He said, why did it drop down? The reasons that he gave me were very temporary. I told my people, I said, back up the truck, buy as many shares as you can. That's what we did. And this stock eventually got up to $4.50. That's I think it's 3 cents to 4.50 is like 150 times on your money. So that's not what we're going to expect. I mean, if you got 10 times on your money, you'd be happy, but sometimes it's just like way better than that. It's just amazing what can happen. So the returns can be enormous. You can never lose because of expiration. There's no time decay. I love that. A lot of the time, the thing that you think is going to happen, it might happen, but it doesn't happen on your time schedule. And I've just seen that happen with so many things in life. You know, the new house that you're building is supposed to be completed by June and you're making plans to move in and you don't actually move in until September. You know, I mean, it's just it's life. You know, stuff comes up and things change. So you can create a legal information advantage. By legal, what I mean by that is this is not inside information. This is not anything you're going to get prosecuted for. But you can create a legal information advantage by simply reading the company's SEC filings and quarterly reports. So you might be thinking, well, can't anybody do that? Yeah, they can, but they don't. So a lot of these companies are down on the OTC, that's the over-the-counter market. Nobody's interested in them. You know, they don't have any analyst coverage. There isn't any big institutions that are trying to tout the stock. And, you know, people barely read the press releases, which are, you know, on Yahoo Finance or wherever, and you know, they're all in great language that's easy to read and they're really fun. People aren't even reading those. So I guarantee you they're not going to get into the SEC filings where it's 47 pages of legalese to try and find out what's going on. So but just by reading these filings, you can learn a lot about the company and see what they're doing. So that's kind of an advantage there. And then you can create a legal information advantage by simply getting acquainted with management. Now, management, if they're smart, and most of these guys are, they're not ever going to tell you anything they could get in trouble for. So they're not going to give you inside information, but they can say, oh, we're doing really good this quarter, or, you know, what they can legally do is they can talk about their competition. You know, the competition's doing this and that, and you can just learn a lot, and you can learn about the character of the people that are managing the company. So I do that. I do not ever invest in a company where I don't know management. I haven't gotten to know them. Sometimes I fly across the country. I visit them at their headquarters. I'll go to their shareholders meetings. I really get to know a company personally before I start recommending things. And one winner, and I think we've seen this, one winner can make up for 10 losers. So the natural reaction when people, when they hear about this in this style of trading, they go, well, Peter, can't you lose your money? And I'm going, yeah, you're darn right you can. I mean, a lot of these companies don't make it. And, they have this great whiz-bang product and, the management's done this and that, and they all have MBAs and they're all fantastic and everything. And it just looks like, you're really counting your chickens and all of that good stuff. And then for whatever reason, or a series of reasons, they just don't make it. So this is not for the faint of heart, but this is the one strategy out of everything that we do where you can literally make millions of dollars. And a lot of our subscribers have. I've had it. We have these live events, these summit events. I have them in some nice place. And usually after we made some huge win, we can kind of celebrate and decide what we're going to invest in next. And I've had people like scream in my face from a foot away, you made me a millionaire. And I'm going, man, that's good. That's what we're trying to do. So this is something you might not know about. I didn't know about. I couldn't even believe it when I first heard it. This is IRS section 1202. And what it says is direct investing into a company with less than a $50 million market cap and held for 5 years or more can potentially result in up to a $10 million in tax-free profits. And you say, Peter, that sounds crazy. Why would the government let you do that? Well, this is a rule that's been in place for over 20 years now. And it's to get us investors to invest in these small companies that don't really have any other way to raise capital. So it's just a great kind of financial incentive to invest in. And, the small businesses, the innovative businesses, this is where all of these incredible technological innovations come from. And, we talk about the NVIDIA, Apple, Microsoft, those started as tiny little companies, an idea, a spark somewhere, sometimes in a garage somewhere. And, can you imagine, being friends with Bill Gates back in high school and, after high school investing $10,000 into his new startup because you think Bill's a pretty smart guy. He always did really good on all the tests. Can you imagine what would happen? Well, if you do that and the company is really small, 50 million or less in market cap when you put your money in, the IRS rule, look this up, Google it on the internet for yourself, IRS section 1202, it allows you to invest in these little companies for a potentially tax-free profit. That one that I just showed you, quantum computing, I just brought in $230,000 with the click of a mouse. Okay, I've held that one for over 5 years. So my accountant, I'm going to have to educate her a little bit this season and tell her, hey, listen, I know that's a pretty good gain there, but I don't have to pay any taxes on it. Company was tiny when I put the money in. I've held it for 5 years or more and boom, no taxes. Pretty darn cool. Okay, let's take a look at the disadvantages. This is important. You can lose all your money. And with tiny companies, it happens all the time. I don't want to gloss over this. I don't want to be one of these guys that says, oh yeah, well that's, those losers are for the other guy. All of our ones, all of the ones we do win or whatever. That's not the way this works. I mean, you don't get in a position to potentially make 100 to 150 times on your money without taking some risk. And so, like I say, that we all have a different risk tolerance. This is not for the faint of heart. This is not for people that can't lose some money on something and like beat themselves up for the rest of your life. That's not what this is about. And if I recommend 10 different positions, you want to do $10,000 and take a flyer on this, you put 1,000 into each one of the 10. Because if you go, well, that's stupid, I'm just going to put 5,000 each into my top 2 picks and spend my $10,000 that way. Here's a crazy thing, and I know it's weird, but sometimes the company that you have the most faith in making it is the one that goes bankrupt. And the little company that nobody was paying any attention to that thought was the worst pick out of the 10, that's the one that makes it. It's just how the world works. So if you're going to do these, diversify, spread your money out. Don't bet it all on red at the roulette wheel. Spread it out and give yourself a chance. So the 1 or 2 that do make it, I mean, you'll make so much money. It's just, I've never seen anything like this before. So I just absolutely love this. I love the game. I love the research. I love getting to know management. And one of the things I love the most is learning about new technology. I mean, there is some just absolutely incredible things that are coming down the pike, and you know about them before. I mean, anybody else? I mean, to give you an idea, one company that we're invested in literally has the cure to virus infections. I mean, it's a biotech, and they've done every single test they do, whether it be a phase 1, phase 2, getting into phase 3. I mean, it's like 100% efficacy. And we're talking about the common cold, the flu. They started trying to do it for the coronavirus, and they figured out with slight modifications, it works for just about any virus. That's viruses that can't be cured, shingles, all of these things. And I'm thinking, not only is this an incredible potential investment, but think about what the amount of suffering it could alleviate in the world. And we've got other things that are just as impactful. And we got another company that's figuring out how to use nuclear waste as nuclear fuel, so we never have a nuclear waste storage problem ever again. We recycle it back through the reactors, existing reactors. This doesn't take some special new reactor. And, you can use nuclear waste as nuclear fuel. I mean, stuff like that just excites me. So this kind of research and this kind of potential and this kind of, the potential to create not just life-changing profits for yourself, but it could be for your entire family. I mean, you can put this stuff in a trust and really, really make a difference in you and your family's lives. So this is super cool. I love it. So those are our strategies, my 3 favorite option strategies, and the one bonus strategy that has just given me so much energy over these last few years and makes it really exciting to be involved. So if you like one or more of these strategies, in our next video, you'll see how to take advantage of them.